Investing is all about growing your money, but not all returns are created equal. You need to look beyond the simple numbers and consider the impact of inflation. That's where real returns come in. Real return is the return on your investment after accounting for inflation. It's the true measure of how much your purchasing power has increased. Imagine earning a 10% return on your investment. Sounds great, right? But what if inflation is also running at 6%? Suddenly, your real return is only 4%. Inflation erodes the value of your money over time. A 10% return doesn't seem as impressive when inflation eats away at half of it. Understanding real returns is crucial for making informed investment decisions. It's not just about how much money you make, but how much that money will buy you in the future. Don't let inflation silently chip away at your hard-earned savings. Focus on real returns to secure your financial well-being. Let's compare two major stock markets, India's Nifty 50 and Japan's Nikkei 225. Over the past 15 years, both indices have shown growth, but their stories are quite different when we factor in inflation and look at real returns. The Nifty 50, representing the Indian market, boasts higher returns. However, India also experiences higher inflation than Japan. This means the real returns for Indian investors are lower than the headline numbers suggest. On the other hand, the Nikkei 225, representing the Japanese market, has delivered more modest returns. However, Japan has faced periods of deflation, which actually increases purchasing power. This means that Japanese investors have enjoyed relatively stable real returns. When comparing investments across different countries, it's crucial to consider the impact of inflation. The Nifty and Nikkei example highlights how inflation can significantly impact real returns. Investors need to look beyond nominal returns and focus on the bigger picture. Inflation is a silent thief, eroding the value of your money over time. In India, high inflation rates have been a persistent concern. Even if your investments generate positive returns, inflation can eat away at those gains. Japan, on the other hand, has faced deflation. Deflation can stifle economic growth. This leads to low demand and economic stagnation. Understanding inflation and deflation is essential for informed investment decisions. Investing in equities always carries some level of risk, but historically, investors have been rewarded for taking on this risk with higher returns compared to safer assets like bonds. This difference in returns is known as the equity risk premium. However, in recent years, the equity risk premium in India has been declining. Several factors contribute to this trend. Interest rates in India have been relatively high, making fixed income investments more attractive. This increased competition reduces the premium investors' demand for investing in equities. Additionally, the Indian economy, while still growing, has faced periods of volatility. This uncertainty makes investors more risk-averse, leading them to demand a lower equity risk premium. A shrinking equity risk premium means that investors need to be more selective in their stock picks. It's crucial to focus on companies with strong fundamentals, solid growth prospects, and sound management teams. Don't just chase returns blindly. Understand the dynamics of the market and invest strategically to mitigate risk and maximize your potential for success. Inflation isn't just an abstract economic concept. It has a very real impact on the daily lives of Indian families. As prices rise, household budgets are squeezed, and families are forced to make difficult choices. For example, the rising cost of food staples like vegetables, lentils, and cooking oil directly impacts the affordability of daily meals for millions of Indians. Families might have to cut back on portion sizes, compromise on the quality of food, or even skip meals altogether. Another area where inflation hits hard is education. The cost of school fees, books, and transportation has been steadily increasing, making it a challenge for parents to provide quality education for their children. Many families have to dip into their savings or take on debt to cover these rising costs. These are just a few examples of how inflation affects the lives of everyday Indians. It's a constant struggle to maintain living standards as prices continue to climb. Deflation's grip. A Japanese perspective. While India grapples with inflation, Japan presents a contrasting scenario: deflation. For over 2 decades, Japan has experienced a prolonged period of falling prices. While cheaper goods and services might seem appealing, deflation can have detrimental effects on an economy. One of the most significant impacts of deflation is on consumer spending. When people expect prices to fall further, they postpone purchases, hoping for even better deals in the future. This decline in consumer demand can lead to a downward spiral of economic activity. Businesses, facing reduced demand, cut back on production, investments and hiring, further slowing down the economy. Deflation also affects wages. Companies struggling with falling revenues may resort to wage cuts or freezes. This reduction in purchasing power further dampens consumer spending, creating a vicious cycle. Japan's experience with deflation serves as a cautionary tale. While inflation can erode purchasing power, deflation can stifle economic growth and impact living standards. Finding the right balance is crucial for a healthy economy. Navigating sentiment. Investor expectations in India. Investor sentiment plays a crucial role in shaping market trends. In India, despite periods of volatility and concerns about inflation, investor sentiment towards the Nifty 50 has remained relatively positive. Several factors contribute to this optimism. India boasts a young and growing population, which translates to a large and expanding consumer base. This demographic dividend fuels economic growth and presents attractive opportunities for businesses. Moreover, the government's focus on infrastructure development, digitization, and ease of doing business has instilled confidence in the long-term prospects of the Indian economy. However, it's essential to remember that investor sentiment can be fickle and subject to change. Global economic conditions, geopolitical events, and domestic policy changes can all impact market sentiment. Investors need to be aware of these external factors and their potential influence on the Indian market. While long-term prospects for the Nifty 50 remain positive, staying informed and adapting to changing market dynamics is crucial for investment success. Investing with prudence. Key takeaways for savvy investors. Investing is a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. When it comes to navigating the complexities of real returns, inflation, and market sentiment, here are some key takeaways for savvy investors. First and foremost, always consider the impact of inflation on your returns. Don't be swayed by impressive-looking nominal returns. Focus on real returns to understand the true growth of your purchasing power. Secondly, diversify your investments across different asset classes and geographies. This helps mitigate risk and protects your portfolio from the volatility of any single market. Thirdly, do your research and invest in companies with strong fundamentals, sound management, and a proven track record of growth. Don't get caught up in market hype or speculative bubbles. And lastly, remember that time is your greatest ally in investing. Stay invested for the long haul, ride out market fluctuations, and let the power of compounding work its magic. Charting your course. Practical tips for long-term success. Here are some practical tips to guide you on your investment journey. Start early and stay invested. The power of compounding is most effective over long periods. The sooner you start, the more time your investments have to grow. Invest regularly. Develop a disciplined approach to investing. Review and rebalance. Periodically review your portfolio to align with your financial goals. Seek professional advice. Consider consulting with a financial advisor for personalized guidance. Remember, investing is a journey, not a destination.